What's up, guys? It's Brandon from Amphibian Trading, and welcome back to another weekly update. If you enjoy these videos, make sure you hit that like and subscribe button so you don't miss any future updates. And now let's go ahead and get into the action. In my last video, we took a look at the QQQ, which is the NASDAQ 100, and we compared that to the QQQJ, which is the next 100 largest companies of the NASDAQ. Since then, not much has changed. The QQQ continues to be the leading index. However, it's essentially gone nowhere for the last 6 weeks. Looking at the weekly chart here, these blue circles represent 3 tight weekly closes of less than 1.5% between the closes. So 5 of these last 6 weeks have had these tight closes. Now, the strength here continues to come from the mega caps, while on the other hand, if we go back to the QQQJ, it shows a completely different picture. It looks much weaker, and now it's actually living below all of its moving averages. If we go ahead and look at, say, the IWM as well, we see a similar picture to the QQQJ. We're below all the moving averages, and they're negatively stacked at this point, meaning we have the 200-day on top of the 50-day, which is on top of the 21-day, which is on top of the 8-day. So unless you're in the QQQ, things aren't looking great on these other indexes. If we go ahead and look at the S&P, this one looks a little bit healthier, but we still need to get above the February peak and this newly formed trend line here. That February peak. So this one does have some hurdles that it's going to need to overcome as well. And the way that we are going to be able to overcome these hurdles is to see breadth come back in, which right now we're not seeing. You can see we still have net lows. And if we're going to have a sustained rally, we're going to need to see net highs come back into the market like we had in this January period with this green background here. Now, while the markets haven't really been impressive lately, they're not breaking down, and there are some stocks that have been standing out, and they have had impressive moves. Most of them are coming from earnings gaps, but those are names you want to be paying attention to for when we do get some market cooperation. So really quickly, let's go over a few of these names that I'm going to be watching very closely. Okay, first up, let's look at HubSpot. This one was basing here with this flat base, attempted to break out, pretty much put in another flat base. It fell just shy of the 5 weeks required. However, we had this nice earnings gap here, and now we're consolidating these recent gains in the range of the earnings gap candle. From there, we have Exact Sciences. We had this nice long basing structure, earnings gap up through the left side high above the pivot, and now we're holding tightly within that range of the earnings gap. Celsius Holdings, this one has this nice long cut base. We also had this multi-touch trend line, which we broke above a few days ago. However, the massive earnings gap into new highs above the left side high of the pivot, holding above that high volume close so far. From there, we have Lantheus Holdings. This one had a earnings gap on the previous quarter and then had another earnings gap this latest quarter, and now we're just drifting higher right above the highs. I believe that is, right near all-time highs there. Uber, another one. This one has the potential to be a liquid leader. We had this nice basing structure, strong earnings move, and now we're up through the pivot and this left side high of the base. Same thing with Shopify. This one attempted to break out earlier in the year with that January rally. It got above this original basing structure. Market cooperation wasn't there, so then it came down and formed this newest basing structure, and now we had our earnings gap here. We're above the left side high of the pivot and consolidating nicely above that. Maybe it'll come down and touch this 8 EMA. Last one we're going to look at is Chipotle. Another one, basing structure here, drifting sideways to slightly higher. Had the earnings gap, putting in a powerful move with an open equals low candle, and now it's drifting sideways, letting its moving averages catch up. Very healthy. And one more thing I want to cover here, because I got some questions about it, is how to interpret my ATR Candles Indicator, and I think that this chart of Chipotle is a perfect example to go over that. So let's go ahead. I'm going to bring up the indicator and we're going to walk through it. Okay, so now we have the indicator pulled up. Quickly, let's go over what it does, and then I'll walk through this example. So these areas where the background is shaded, that is when the short-term ATR value is greater than a longer-term ATR value, showing that near-term volatility has increased. So looking at this chart, we have a base-on-base pattern. We have this first double bottom base that Chipotle formed, and then we have this second flat base here that forms. So let's go ahead now and take a look at these two bases using the ATR Candles Indicator and see what the differences are. So starting here with this double bottom base, you can see as we formed this left side, we came down and our volatility had increased, our near-term volatility, due to the short-term ATR being greater than the longer-term ATR, which we can see with these backgrounds being shaded. We also have lots of full ATR candles to the downside, which are these orange candles here, as the stock came down, making this first leg lower. Volatility did decrease a little bit as we attempted to push up the right side. We ended up forming this middle peak before we came back down. As we did get to the bottom this time, volatility dried up, and we actually saw what you want to see is volatility increasing to the upside as you attempt to break out, which we did get. However, at the same time this attempted to break out, you can see the market here, which is this orange line, started to roll over into a correction. What that did was set the stage for this next base, where as the market started correcting, we had some volatility, but then look at what happens here. Our background stays white, pretty much this whole basing structure, and we see lots of these light blue candles, which means that they're moving less than 50% of the ATR. So volatility really contracted during this phase as the stock built its base. You can see then, as we attempted to break out, we had a couple candles that were full ATR moves. However, we still saw volatility not increasing too much, more light blue candles here and here. Now, as we come up to our earnings day, we get this big blue candle here, which means that we moved over 1.5 times the ATR. And that did go ahead and increase that short-term ATR to a value greater than the long-term ATR, which turned this background back on. So we saw what we wanted to see. We had a consolidation period where volatility contracted and then volatility expanded to the upside on this big earnings gap. And then now look at here, we're starting to consolidate again. Lots of nice light blue candles showing that the ATRs have been smaller. And now our background is back to the white, showing that the stock is just holding on to the gains. Volatility is not there. Short-term ATR is less than our longer-term ATR, which is healthy. And that's what you want to see as the stock digests gains and potentially sets up for another move higher. I hope that makes sense. If you have any other questions on this indicator, feel free to leave them in the comments or send me a message on TradingView or Twitter. Thank you for watching. If you enjoyed this video or found any of the information useful, please go ahead and hit that like and subscribe button so you don't miss any future updates.